Hi dear students, good evening all of you. Our new chapter, capital budgeting. Yes. See, this is a lengthy chapter actually. You need to invest more number of hours on this particular chapter when compared to other chapters. We have another chapter called working capital management also. In that chapter also, you should invest more number of hours. So these are the two lengthy chapters in the entire subject of financial management. Now dear students, let us understand the requirement of this chapter, capital budgeting. First of all, you know that every firm or company will raise funds, the required funds, from several sources, generally equity, preference, debt, like that. Let me take the two sources like equity and debt. So based on your financing decision, you'll raise the fund. So by taking the factors called risk and return, I'll take financing decision and accordingly I'll raise the required fund through equity and debt. Nothing but it is about how much fund must be raised through equity and how much fund must be raised through debt. So after raising this fund, in which way I should invest this money, how effectively I should utilize this money. Nothing but what it's about effective utilization of funds in the business. So it's all about selection of the project which is based on investment decisions. So in which project I should invest. So first of all, I have to decide among many projects I should select the best project. So after selecting the projects, I'll acquire the funds, I'll acquire the assets accordingly based on the requirements of the project. Now the question is, this chapter, capital budgeting, is related to financing decision or investment decision. It is purely related to investment decisions, not related to financing decision. I'm nowhere concerned with what this particular decision called financing decision. This particular chapter, capital budgeting, it's all about asset side discussion, nothing but investment decision. Okay. So my dear students, the other name for investment decisions is capital budgeting decisions. Capital budgeting decisions. This is about capital budgeting decisions. So what are these capital budgeting decisions? In simple terms, in this particular chapter, we are going to select the best projects out of many projects which are available in the market. So I can say simply, it's all about selection of the best project. So this chapter deals with what? Selection of the best project in simple terms. So in typical terms, it's about evaluation of the projects and selection of the projects. Evaluation of the capital investment proposals in the market. That's what the technical way of understanding. So this particular capital budgeting deals with evaluation of capital expenditure proposals. Or capital investments. In order to generate best returns in the future. In order to generate what? The best returns in the future. Nothing but it's about business selection. It's about business selection. Or I can say project selection. Business selection or project selection. In simple terms, it is the art of using company's money in order to generate best returns from our investment in the future. So that's what the better way of understanding this capital budgeting decisions. So dear students, capital budgeting is all about evaluation of capital investment proposals or capital investments. Sir, what are these capital investment proposals or capital investments? Nothing but business, like investing in a new business line, a new product introduction, or otherwise expanding our existing business lines, or replacement of existing assets, or doing some research and development, or exploration of several resources, natural resources, like that, or buy or lease decision. Like that, we have to take several capital budgeting decisions. We have to take several investment decisions And this particular chapter deals with all of these capital expenditure proposals. Okay. So whether we should invest larger amount of funds in the business or not. That's what this chapter is all about. Okay. Yes. Now, after investing money today, nothing but by investing capital expenditure today, capex today, larger amount of funds today, I'm going to get the future returns. So if you invest larger amount of funds today, you'll get future returns. So by investing money today, I'll get what? The future benefits. So in capital budgeting decisions will decide by investing money, by effectively utilizing the money, company's money, how effectively the company is able to generate best returns in the future. Okay, this chapter deals with this aspect also. So the evaluation requires a lot of analysis. The evaluation requires a lot of analysis. Let us go for some of the theoretical contents in this particular chapter. Now, here is the chapter name, capital budgeting. So I'm going for this importance or need of capital budgeting decisions. We need to go for expansion, replacement, diversification, entering into new products, replacement of existing business assets, land and buildings, plant and machinery, furniture and fixtures, buy or lease decisions, research and development decisions. Prima facie, we have to handle these areas: expanding the existing business line, replacement of the existing assets, diversification, nothing but entering into new product lines, and buy or lease decision. If you want to purchase an asset, can you go for buying, or you can go for leasing the asset from lesser companies. And research and development, can I go for research and development project or not? So this is what the importance of these capital budgeting decisions. So before expanding the business line, I have to take a decision called investment decision or capital budgeting decision. Expansion decision is one of the capital budgeting decision. Replacement of the assets is one of the capital budgeting decision. Diversification into new product line is one of the capital budgeting decision. Buying an asset or leasing an asset, taking decision related to that, that is also one of the capital budgeting decision. R&D, can I go for R&D or not? That is also one of the capital budgeting decision. Okay. So these are some of the important areas we need to deal. Now, dear students, significance of capital budgeting decisions. Why these capital budgeting decisions are so important? That's what our discussion actually. So these capital budgeting decisions are crucial decisions. Why these crucial decisions? Why these decisions are crucial? Because these decisions are going to affect almost every department of the organization. It affects almost every department of the organization. Yes. All the departments of the firm are going to be affected. Yes. Sorry. Yes, all the departments of the firm are going to be affected. So the capital budgeting decision should be taken very carefully. So, and also these decisions are long run decisions. Long run decisions means if you invest today, these decisions will have an implication on long run. Like after 10 years, profitability is going to be decided based on today's investment. Okay. Long run decisions. Once invested, it will have a huge impact on long run future. Larger amount of funds are involved here, not the smaller amounts. Very large amounts are involved here. Lakhs of crores are going to be involved in these particular capital budgeting decisions, because every business in the world are purely decided by these capital budgeting decisions. Business means thousands and lakhs of crores are involved. Larger amount of funds are involved. Rigid decisions. Once these decisions are taken, cannot be altered. So if I have invested 1,000 crores today, immediately after 1 month, I cannot change the entire project. So alteration is not possible. That means I cannot reverse the decision. Rigid decisions. Cash forecast. Capital budgeting decisions requires larger amount of funds in the near future also. So if you invest in the business, such business requires funds in the future also. In the future years also, you need to invest based on the requirements. I may need to invest in working capital, or I may need to invest in assets purchasing, replacement. So I need better cash forecast. Cash forecast means estimating the cash flows, how much cash inflow I'm going to generate in the future. So you need to prepare a cash forecast. These investment decisions will maximize the shareholders' wealth. A better project, a good project will always maximize the shareholders' wealth. A bad project will reduce the shareholders' wealth and helps in policy making. Generally, see, these capital busting decisions will assist in policy making. I can change my policy based on the capital busting decisions also. See, this is all about theoretical understanding. Now, let us go for this. Yeah, dear students, these capital busting decisions will decide the future revenue of the organization. The profits of the firm, the growth of the firm is purely dependent on these investment decisions or capital busting decisions. If I select a wrong project, that may generate losses in the future. If I select a best project, that is going to generate absolute higher profits in the future. So the selection of the project is very important and crucial for the organization. Now, dear students, let us understand few examples in the market to understand these capital busting decisions or investment decisions. So if you see, I'll take the most familiar examples to everyone. You know that Reliance Jio, this is a big project, a revolution in the telecommunication. Actually, earlier we used to use the cell phones and we used to communicate with each other by spending a lot of money. And Mr. Mukesh Ambani came up with a big project in the year 2016, and that is what Jio. So this Jio introduction collapses every market. Vodafone, Airtel, Idea, all those markets were completely collapsed because of this Jio project. Why, sir? We used to spend a lot of money on communication at that time. For communicating 1 minute, we used to spend 1 rupee. At that time, at least 60 paisa. But now, the tariff rates are very economical and very low because of this project. So this particular project is a big revolution in the market. At that time, he introduced this project called Jio by spending approximately 250,000 crores. Initially, he invested 150,000 crores on the project, capital busting project. Remember that. That's a big, huge capital expenditure, very large amount of fund. And then he invested again 1 lakh crores. Now he's leading the entire India. He's one of the, this particular Jio is one of the biggest communication network in India. So this is also one of the capital busting projects. See, by investing 250,000 crores, he earned a lot of money. So if you look back this year 2016, he invested nearly 250,000 crores. Now he is generating better benefits. So this particular project is generating revenue now, but the investment was made in the year 2016. So I can say this is one of the capital busting project, investment project or investment decision which is being taken by Mr. Mukesh Ambani. So at that time, he evaluated the project. So he selected the project. Definitely, he did a lot of analysis with his team. So this particular chapter deals with this type of projects actually. Jio is one of such project, capital busting project or capital busting decision. So Mukesh Ambani has taken one of the capital busting decision or investment decision through his team. So dear students, this is one of the best example for a successful project. He invested it, he earned it. He is earning lot of money from this particular project. Yes. My dear students, this is one of the best example for a successful project, successful capital busting decision or investment decision. Now let me go for a failure project. Have you heard about the term nano car? Tata Nano is a big failure actually. So Ratan Tata invented through his team a brand called Nano, a cheapest car in the world, with a price of 1 lakh rupees only. With a price of 1 lakh rupees only. So he started this project to rule the world. In fact, immediately from first from India actually, but ultimately he was unable to capture the market because of so many reasons. This brand became a big failure in the market, especially in India. There are so many reasons behind it, but he invested thousands of crores in this project, but that particular project was a big failure. This is also one of the capital busting decision or investment decision which is being taken by Mr. Ratan Tata, but unfortunately it became a big failure. Now, you can go for the contents why there is a huge failure on this particular project. The reasons behind this particular Tata Nano's marketing failure. Look at this chart. Look at this chart. From year to 2010 to 2010-11 to 2016-17, gradually the sales is reducing. Initially, they captured a market of 30,350 sales units. They were able to sold 30,350 cars in the year 2009-10, 9-10 actually. And in the year 2010-11, they reached the peaks 70,432. And after that, they reached the peaks level of 74,527 cars sale units. And gradually the sales is reducing. In the year 2012-13, the sales is 53,848, 21,129, 16,901, 21,012, 7,591, and finally they close the plant. This is a big failure actually. There are so many reasons. See, invalid market analysis. They were not able to understand the market, the requirements of the market, and this is Laktakia positioning. See, with 1 lakh rupees purchase price, the plan to grab the entire market, but that was a big failure because of the cheapest price. People thought that they might need to compromise the quality, and because of that reason, people were not interested to buy this car because of what? Lack of confidence on the quality of the product. So this is also one of the reasons. And then the logic over emotion. See, people will prefer emotions in India over logic actually. So the logic, they didn't get the logic and they preferred emotion, and they bought other cars rather than this particular car, even though it is available at an economical price of 1 lakh rupees. The hype, they were not able to create hype for this product, and then negative PR, and these are all the reasons. So we don't need this content actually. I just wanted to explain. This is also one of the capital busting decision which is being taken by Mr. Ratan Tata, but ultimately it became a failure. So we have one successful project on one hand, and we have one failure project on the other hand. These two are capital busting decisions only. So your capital busting decisions are investment decisions. That means by investing larger amount of funds in the business will decide the company's future, the company's shareholders value, the company's share value or shareholders wealth. So a successful project will maximize the shareholders wealth, and a failure project will reduce the shareholders wealth. So you should be very careful while selecting the projects. So how to select the projects and what is the process of this capital busting? That's what our next discussion. Thank you. So let me go for the theory content. Yes, the process of capital busting. The process of capital busting follows these steps. Generation of the project. So what kind of project you're going to take up? Evaluation of the project. So you have to study the costs and benefits associated with the project. Selection of the project. You should select the project after your evaluation, and execution of the project. Then start your project. Nothing but invest your money in the assets and start your production and start your sales. This is what the process of capital busting. So what is the process? Generation of the project. The generation of the project can be a new product introduction or expansion of the existing products. I may go for expansion of the existing products into several areas, or I may go enter into a new product line, completely into a new product line. Say for example, I'm manufacturing cars, I may enter into bikes. That's what the diversification. Okay, I'm manufacturing cars, I may enter into I may enter into another sector of business. I may enter into insurance business, or I may enter into banking business, or I may enter into any other, I may enter into what this particular manufacturer of computers, like that. So, or I may enter into software sector, or I may enter into iron and steel business, like that. if I introduce a new product, that is one of the project, or I may go for expansion of the existing business lines. This is generation of the project, or replacement of equipment or building. The existing plant and equipment can be replaced, or I may go for replacement of existing building, a old building. This is what another generation of the project. Generation of the project is means what kind of project you're taking up. Such project can be introduction of the new product or expansion of the existing product, or replacement of the existing assets like equipment, plant and equipment replacement, or building replacement, or you can go for research and development of for creating a new innovative product, or I can go for exploration, or I can go for others like acquisition of a pollution control device. These are all what generation of the project, etc. See, this generation of the project, depending upon the nature of the project, depends upon the requirement of the organization. Okay, ultimately, definitely and ultimately, there should be an investment. Okay, remember that there should be huge investment in the business. That's why then that is what the generation of the project. So after generating the project, see, we got one idea, business idea, introducing a new product line. So I got the business idea. So let me evaluate the project. See, remember one thing, I've not invested the money till now. I got an idea, and I'm planning to invest in the project. So before investing large amount of money in the business, first I should evaluate the project. I should evaluate the new business idea or new business project. So what is this evaluation? My dear students, evaluation involves, this can be done in 2 steps. That's what they're saying. The first step is calculate or identify the costs and benefits of the project. The costs and benefits. Cost means purchasing the fixed assets and incurring the revenue expenditure. So nothing but what? Spending a lot of money on fixed assets and spending recurring revenue expenditure. These are nothing but what? The costs. And also I'm going to get what? The revenues in the future. Nothing but the cash inflows. So I should calculate the costs and benefits associated with the project in the future, so that I'm going to get what? The cash inflows, as well as I'm going to incur what? The cash outflows. These are simply known as cash flows. All the costs are known as cash outflows, and all the benefits are known as cash inflows. COs, CIs. CIs means cash inflows, COs means cash outflows. Secondly, the desirability of the project is judged by the appropriate criteria. The desirability, after estimating the costs and benefits associated with the project, the benefits and costs must be matched. Such matching should be done by using the techniques which we need to understand in the future. Capital budgeting techniques in this chapter. Such capital budgeting techniques will decide whether you should accept the project or not. The selection of the project is purely based on decision which is being taken based on what? The application of capital budgeting techniques. So appropriate criteria means the application of capital budgeting techniques. Such techniques will decide whether you should select the project or you should reject the project. So this is what the desirability of the project. Desirability of the project is nothing but accept or reject. Okay, accept or reject decision. So these are the 2 important steps I should be very carefully consider. Evaluation of the project. Evaluation involves 2 steps. One is what? Estimating the costs and benefits, or cash outflows and cash inflows associated with the project. Then comparing such benefits and costs, whether such project results in net benefit or net loss, by applying capital budgeting techniques. Okay, that's our next discussion, capital budgeting techniques. Then finally, if your technique says select the project, then you should select the project. If your technique says reject the project, then you should simply reject the project. So the next area is selection of the project. So I should select the project after evaluation. So if I select the project, then I'll execute the project. Execution means simply invest the funds now and then start your production, go for sales, do every business activity, and so that is what execution of the project based on your plan of action. Okay, this is the process of capital budgeting. Yes, we understood the process of capital budgeting. Now, so dear students, in this particular session, we understood the importance of capital budgeting decision, importance of capital budgeting decisions and need of capital budgeting decisions, and then what? The significance of capital budgeting decisions and the process of capital budgeting decisions. This is what we understood. Now, let us go for the other areas in this chapter. Okay. Sorry. So dear students, let me start with the first area in this chapter, evaluation of the projects. See, this evaluation involves two steps: cost benefit analysis. The first area is cost benefit analysis. Nothing but defining the benefits and costs associated with the project. The second area is desirability of the project, deciding whether we should accept the project or rejecting the project. Desirability of the project. So these are the two important areas in the evaluation of the projects. So let me start with the first area, cost benefit analysis. Cost benefit analysis. This is the first area. See, dear students, first of all, this cost means cash outflow. Anything that is going out of your pocket is cash outflow, which is known as cost. This benefit means cash inflow. So anything that comes into the organization, that is cash inflow, generally the revenue. Okay. So cost means cash outflow, benefits means cash inflow. So I need to define the cash outflows and cash inflows associated with every business project. Okay. Now, let me go for this particular area called defining the costs and benefits, cash outflows and cash inflows. Let us consider one project called Project A. Project A. So this project's life is 5 years. 1, 2, 3, 4, 5. If you invest money today, say for example, I'm investing today, you know that investment means investment in two components. Every business requires two components investment. One is investment in fixed assets. This is your first investment. Within brackets, it should be mentioned within brackets, investment in fixed assets. The second one is investment in working capital. Working capital is generally the required fund to run your business. This particular working capital is required for every business to meet day-to-day operating expenses. So one should invest in fixed assets along with working capital investment in every project generally, unless otherwise specifically mentioned. I always consider investment in fixed assets and investment in working capital. This is my cash outflow in simple terms. This is my cash outflow. Or I can say these are my cash outflows. Okay. Now, dear students, after investing money, what will happen? I'll start my project. I'll start my production. Throughout the year, I'll produce the products. And throughout the year, I'll generate the revenue, which is nothing but sales. And I'll incur expenses throughout the year. So throughout the year, I'm going to generate revenue. And throughout the year, I'm going to incur expenses, the revenue expenditure. So sales is a benefit, revenue expenditure is a cost. But the sales and revenue, the sales and expense, these sales and expenses are occurred throughout the year. But for the sake of simplification in these capital budgeting decisions or for application of all these capital budgeting techniques, I'll assume that both sales and expenses are assumed to be occurred at the end of each year, even though those numbers are accrued or generated throughout the year. So my dear students, even though you're generating sales throughout the year, and even though you're incurring expenses throughout the year, it doesn't matter. Just for the sake of simplification, decision making simplification, I'm just assuming that both sales and expenses are assumed to be occurred at the end of each year. So sales is a benefit, expenses are your costs. So after recovering your expenses from sales, I'll get profit. And from these profits, after adjusting few numbers, I'll get cash inflows. See, profit is a benefit. And to that benefit, I'll adjust one number called depreciation. Then I'll get cash inflows. This cash inflow is the benefit actually. So sales is your benefit, dear students. Expenses are your costs. Benefits minus cost results in profit. Or such profits can be before tax, before depreciation profit or after depreciation profit. Generally, profit after adjusting a few terms to profit, I'll get what the cash inflow. This is a simple way of understanding. So like this, every year I'll get cash inflows. Second year, third year, fourth year, fifth year. These cash inflows which are generated for every year are simply known as operating cash inflows. Operating cash inflows. Dear students, operating cash inflows means the cash inflows which are generated during the regular course of operation, especially from your main business activity. Okay, so I'll consider only the cash inflows related to our main business activity. I don't consider other items like profit on sale of fixed assets, profit on sale of investments, interest received and dividend received on my investments. Such type of numbers are not going to be considered in these operating cash inflows. So your operating cash inflows are pure business in nature, purely related to your business. So I can say related to your manufacturing operations, or I can say related to your regular business operation. Okay. So if you are manufacturing concern, manufacturing operations. If you are a trading concern, operations related to your trade, nothing but sale and buying and selling. So, and then if you are running in a hospital, so the your operations are nothing but what the revenue which is generated from your OP, and then operations, I mean the regular operations, like that. Okay. See, this is purely related to your business operations. The nature of business operations will generate these operating cash inflows. Yes. So these operating cash inflows will be generated throughout the project life. Then finally, at the end of the project, what I'm going to get, what are the money that I've invested in the business in year 0, that is going to be released. Not fully, a part amount. See, since I've invested a lot of money in the fixed assets like buildings, plant and machinery, furniture and fixtures, and such assets are going to carry some salvage value at the end of the 5th year, which is known as terminal year. This is a terminal year. Okay. Any cash inflow which is generated at the end of the year, project life, project ending year or terminal year, is simply known as terminal cash inflow. Terminal cash inflow. Yes. See, there will be two components in terminal cash inflow. Since I have invested in two components at the start of the project, at the time of starting the project, I've invested in two components like investment in fixed assets and investment in working capital. Those two numbers are going to be released at the end of the project life. See, these fixed assets will carry salvage value, whereas this working capital will be released fully. Completely it is going to be released. So why this working capital is going to be released fully, I'll explain that part later. Let me take the process first of all. So the fixed assets will carry some salvage value. That is your first terminal cash inflow, salvage value of your fixed assets. And what are the money which you have invested in year 0? That is going to be released fully, realized fully, related to your working capital. That's what realization of working capital. Realization of working capital. That is my second terminal cash inflow. So there are two important components in your terminal cash inflow. One is the salvage value of fixed assets. Other one is realization of working capital. Add these two numbers. That is your terminal cash inflow. TCI, terminal cash inflow. This is a simplified understanding of the entire project's cash flows, both outflows as well as inflows. Okay. Now, dear students, see this. 0 period investment is your cash outflow. Investment in fixed assets and investment in working capital. After investing your money in year 0, every year you're going to get a cash inflow by deducting expenses from sales, which is known as what? Operating cash inflow. You should know how to calculate this operating cash inflow. So at the end of each year, this operating cash inflow will be generated. Though it is generated throughout the year, I'm just assuming that these operating cash inflows are occurred at the end of each year. At the end of the project life, terminal year, project ending year, I'll get terminal cash inflow. That involves two components. One is the salvage value of fixed assets, other one is realization of working capital. The sum is terminal cash inflow. Okay. Now, this particular entire project's cash flows should be presented in a process. Okay. I'll give you few steps to understand these cash flows, defining the cash flows. 4 steps. In 4 steps, I'm going to define these cash flows. Cash outflows, initial cash outflows, operating cash inflows, and terminal cash inflow. Okay. Step number 1. First of all, defining the cash flows. Or identification of cash flows. Identification of cash flows or defining the cash flows. Okay. Yes. Step number 1. In step number 1, I'm going to take initial cash outflows, capital expenditure and working capital investment. Calculation of initial cash outflows. This is step number 1. So what are your initial cash outflows? You know that the first component is investment in fixed assets. Investment in fixed assets. The second one is investment in working capital. You know, my dear students, working capital investment is nothing but investment in current assets like stock, debtors, cash. Maintenance of current assets is nothing but working capital investment. Every business requires working capital investment along with fixed assets investment. Fixed assets and working capital are like two eyes of every company. Okay. Both are important. This is step number 1. So your initial cash outflows involves 2 steps. Two components. Fixed assets investment, working capital investment. Step 1 is over. Now I'm moving to the step 2. In step number 2, I'll calculate depreciation. Calculation of depreciation. Depreciation can be calculated either on SLM basis or on WDV basis. It can be calculated based on SLM or WDV. That is step number 2. Now I'm moving to step number 3. Calculation of operating cash inflows. This is step number 3. So what is step number 3? Calculation of operating cash inflows. You know, for the entire project life, for every year, I'm going to get this operating cash inflow. Particulars year 1 to n. 1 to n means project life. It depends. It can be 5 years or 10 years or 15 years. It depends. Okay. 1 to n years. First, I should write sales. This is my first revenue, a benefit. From this sales, I am going to deduct 2 expenses, your total cost, which is classified into 2 components, variable cost and cash fixed cost. So sales minus variable cost. That gives me contribution. Minus cash fixed cost. So what is this cash fixed cost? You know, your fixed cost is a combination of 2 components. Fixed cost involves, fixed cost includes cash fixed cost and non-cash fixed cost like depreciation. Okay. So I'm just taking cash fixed cost only. So sales minus variable cost. sales minus variable cost contribution minus cash fixed cost, then I'll get PBDT. This is simply known as profit before deducting depreciation and tax. In simple words, it is profit before depreciation and tax. So by this, I've deducted revenue expenditure from sales because I have deducted variable cost and cash fixed cost. Both variable cost and cash fixed cost total is total cost. Total cost means direct material, direct wages, direct expenses, factory overhead, administration overhead, and selling and distribution overhead. Only cash overheads. So the sum of all these expenses is total cost. If you classify such total costs into two parts, variable and fixed, based on its behavior with the production or sales volume. So by deducting this variable cost and cash fixed cost, I was able to reduce my revenue expenditure. So successfully I've deducted my revenue expenditure, variable cost and cash fixed costs. So yet I'm recovering, yet I have not recovered capital expenditure. Remember that. Okay. I've just recovered only revenue expenditure, variable cost and cash fixed cost. So by deducting this variable cost and cash fixed cost, I've deducted what? Material, labor and overhead expenses. Then I got PBDT. Now from this PBDT, please deduct depreciation. You know, my dear students, depreciation deduction is nothing but deduction of capital expenditure. This is nothing but recovery of capex or capital expenditure. But not fully, partial amount only. So how it is a recovery of capital expenditure? You know, say for example, if I invested 100 crores in the project and that is going to be written off over a period of 10 years, that means every year the depreciation is 10 crores. So if I deduct 10 crores every year, since that is a non-cash expenditure that never reduces any cash balance of the firm, this 10 crores remains with the company only. Even though you're deducting depreciation from PBDT, that remains with the company only. So this is what the recovery of what your capital expenditure. So every year I'll recover 10 crores from sales that remains with the company only. So by the end of 10th year, I'll get 100 crores completely. 10 crore into 10 years, 100 crores. I'm going to recover entire 100 crores from the project over a period of 10 years by deducting 10 crores every year. So deducting depreciation from PBDT is nothing but what? Recovery of capital expenditure, recovery of investment made in fixed assets or the entire project life. Okay, that's what depreciation deduction. So my dear students, I can say one thing. By deducting variable costs and cash fixed costs, I've recovered revenue expenditure, and by deducting depreciation, I've recovered capital expenditure. Then I'll get what? Profit. Without deducting capital expenditure, nothing but depreciation, you don't get profit. Don't consider PBDT as your profit, because which is supposed to be reduced by depreciation. Without recovering depreciation from PBDT, don't consider PBDT as your profit. Profit means what? Profit is a term which is profit is a term which is going to be earned after recovering revenue expenditure as well as capital expenditure. Without deducting capital expenditure, you don't get what? Profit. So PBT less. Then from this is PBT. PBT is my profit, but that is before tax profit. Recover your income tax, nothing but deduct your income tax from it. Then I'll get profit after tax, PAT, profit after tax. So this is my profit, ultimate profit. So my dear students, remember one thing. PBDT is not your profit, even though we are calling it as profit before depreciation and tax. It is not your profit, whereas PBT is your profit, but before recovering your income tax, deducting income tax. So which term is your ultimate profit? I can say the only term which is representing profit in this statement is PAT. This is pure profit. Profit is nothing but the profit is nothing but which is a term, which is the number earned after recovering all the expenses from your revenue. So what are those expenses? Both revenue expenses as well as capital expenditure. Okay. After recovering revenue expenditure and capital expenditure from sales, I'll get what? Profit. So never ever consider PBDT as your profit, because which is supposed to be reduced by depreciation. And don't consider PBT as your profit, because which is supposed to be reduced by income tax. So the only term which is representing profit is PAT. Okay. Yes. And to this profit, I'll add one term called depreciation. So why you are adding depreciation here? Because that's a non-cash expenditure which is already deducted, which never involves any cash outflow. The cash remains with the company only. You can see that money in the company only, because even though you're deducting that number from sales, that remains with the company only. That is going to be available with the company only. So I'm adding that number to this particular profit after tax. So I've deducted one non-cash expenditure that never involves any cash outflow. That's what depreciation, non-cash expenditure. Since it is a non-cash expenditure, you're deducting it, and then you should add it after PAT. So this particular term is simply known as CFAT, or this is also known as operating cash inflow. Operating cash inflow. Now the question, sir, what is the CFAT? CFAT is nothing but cash flows after tax. Cash flows after tax. See, this particular cash flows after tax, it has one true meaning actually. I'll explain those terms related to these cash flows later in our later sessions. Just understand that this term is known as cash inflow, operating cash inflow. Technically, this is known as cash flows after tax. Cash flows after tax. Now, dear students, what is the difference between profit after tax and cash flows after tax? You know, this cash flows after tax is not your profit. This is profit plus, don't say depreciation, I'll say investment recovery. Profit plus investment is CFAT. So your CFAT is loaded with two components. One is your profit, another one is the money which you have invested in year zero, investment. So these two components are included in this term called CFAT, or operating cash inflow. So my dear students, the only term which is representing profit in this particular statement is profit after tax. PAT is the only term which is representing profit. CFAT is not the profit. This is a bigger number. CFAT is a bigger number which is able to recover your investment also. So CFAT is loaded with two components, profit plus investment. Remember one thing, profit is not going to recover your investment. That has no such capacity. PAT cannot recover your investment. The only term in this statement which can recover your investment along with profit is CFAT. CFAT is a term which is going to recover your investment as well as it will generate some profit. So profit after tax is just representing profit only. Never ever think that I'm going to recover my investment from profits, because profits cannot recover your investment. The only term which can recover your investment is CFAT, or operating cash inflow. So this is regarding defining the operating cash inflows. So I'm just repeating it. Sales minus variable cost, contribution minus cash fixed cost. I got PBDT. By that I have recovered my revenue expenditure, nothing but the total of material, labor and all cash overheads. Then I got PBDT. From that I'm recovering my capital expenditure, called a part of capital expenditure, a part of fixed assets investment, which is nothing but depreciation. That's a non-cash expenditure. Even though that's a non-cash expenditure, you must deduct it. Then I got PBT less income tax, PAT, add depreciation, CFAT. PAT is profit, CFAT is profit plus investment. Now the biggest question arises, sir, why you are deducting depreciation and why you are adding depreciation? Instead of that, you don't need to adjust that. Don't deduct it, don't add it. The net effect remains same. Why you are deducting and why you are adding? There is a reason. You know, my dear students, for calculating income tax liability, you are supposed to deduct revenue expenditure as well as capital expenditure. You know that there is a section called section 32 which says what? Depreciation is one of the taxable, deductible expenditure, allowable expenditure. One can deduct a depreciation from the sales for arriving what? Taxable profit, PCBP, under the head PCBP. But such depreciation must be an allowable depreciation under the provisions of Income Tax Act, nothing but section 32. We have so many provisions related to that. Now, my dear students, since the act says you should recover your capital expenditure, depreciation from sales, then only calculate tax on the profit. So for arriving taxable profit PBT, one should deduct depreciation. So I have deducted depreciation, I got taxable profit. On that taxable profit only, I must apply tax. If you apply tax on PBDT, you are supposed to pay higher tax liability. So nobody is interested to pay tax on PBDT without deducting depreciation, because everybody wants to recover their investment. Then only they'll get profit. On that taxable profit, they'll pay what? Income tax. So It acts as what? Deduct depreciation and on taxable profit PBT, calculate tax. Don't calculate tax on PBDT. Never ever calculate tax on PBDT. Okay. So because of that reason, deduct depreciation before calculating tax liability. Once the tax computation is over, once the tax recovery is over, then you got profit. So to such profit, add your depreciation again. So why you're deducting and why you're adding? For getting tax saving, I'm reducing such a huge number called depreciation from PBDT. If I pay tax on PBDT, I should pay higher tax liability. I don't pay higher tax liability, I'll pay lower tax amount. Also, for that reason, I'll apply tax on PBT only. So deduct your depreciation from PBDT, then get the taxable profit, deduct the tax liability, and then arrive the profit. To that, add back depreciation. So once we add depreciation, because that's a non-cash expenditure, I'll get what? CFAT. So there is a reason why you're deducting depreciation and why you're adding depreciation. To get what? Tax saving. To get tax saving. If you don't deduct depreciation, you're supposed to pay higher tax. So to reduce your tax liability, you must deduct depreciation. This is a simple way of understanding actually. So I can say one thing: depreciation is a before tax deduction and after tax addition. It's a before tax deduction and after tax addition. So before calculating tax liability, deduct depreciation, and after calculating tax liability, add depreciation to get what? CFAT. That's what the understanding of this statement called calculation of operating cash inflows. So just look at the term: sales minus variable cost, contribution minus cash fixed cost. I got PBDT minus depreciation, PBT, income tax deduction, profit after tax, add depreciation, CFAT or operating cash inflows. My dear students, again and again I'm repeating. It may be very boring to you, but remember, these terms are very important. CFAT or operating cash inflow. This is a term which is loaded with two components: profit and investment. PAT is a term which is representing pure profit. PAT is profit, CFAT is profit plus investment. Remember that. Okay. So please copy this content once. Hopefully you can do it from the very beginning. Okay. Yes. Okay. So in our next session, I'm going to explain how to calculate terminal cash inflow. Okay. Thank you so much. Bye. Hi dear students. Good morning all of you. Now we are handling the chapter capital budgeting, and in that we understood how to define cash flows. So as part of that, actually we have completed 3 steps and we understood how to calculate operating cash inflows. Now dear students, let us go for 4th step, that is terminal cash inflow. Step number 4. Yes. Step number 4. Calculation of terminal cash inflow. Already I told you, your terminal cash inflow includes 2 components: salvage value of fixed assets and realization of working capital. These 2 are the important components of your terminal cash inflow. But while taking this salvage value, I must adjust one tax called capital gain tax. While selling the asset at the end of the terminal year, you're supposed to pay what capital gain tax, if at all, if you're earning some capital gain by selling such capital asset. So let me adjust such capital gain tax also for arriving this terminal cash inflow. So there will be two components. One is salvage value of the fixed asset, nothing but sale value of the fixed asset. Another one is realization of working capital. Let's say for example, I am selling my fixed asset at a sale value of 1 lakh rupees. This is my gross sale profits. This is my gross sale profits. That means I'm selling my fixed asset at 1 lakh rupees, whereas the book value of the same asset at the end of the project life, nothing but at the terminal year, is 90,000. So dear students, you are selling the fixed asset for 1 lakh rupees, which is having a book value of 90,000. So you are earning a capital gain of 10,000. So the point is, basically this 1 lakh rupees is your inflow, cash inflow, terminal inflow. But while selling this fixed asset, you are earning this capital gain. So department says, income tax department says, since you are earning capital gain, please pay capital gain tax. So such capital gain tax payment is a cash outflow from the company's perspective, which is supposed to be deducted from gross sale profits in order to arrive net cash inflow or net sale profits. Okay. So you have to calculate capital gain tax on capital gain. Capital gain tax. Say for example, your capital gain tax is 30%. So it will be 3,000 on your capital gain. So this is your outflow. Dear students, this gross sale process is a cash inflow to the company. Capital gain tax is a cash outflow to the company. So this outflow must be deducted from the inflow in order to arrive net sale process. So A is the gross sale process, B is the capital gain tax. So let me calculate net sale process here. Net sale process. A minus B. It will be 1 lakh inflow minus 3,000 outflow. It will be 97,000 net sale process. This is what the format of calculating net sale process, dear students. So how to calculate net sale process? Gross sale process minus book value, capital gain. On capital gain, you must pay capital gain tax. Such capital gain tax must be deducted from gross sale process in order to arrive net sale process. So gross sale process is a cash inflow. Net capital gain tax is a cash outflow. So cash inflow minus cash outflow, gross sale process minus capital gain tax, I'll get net sale process. See, just for the sake of understanding, I've taken one example here. Generally, you should write this particular step number 4 in a format. Okay. So I'm not taking these numbers now. I'm just taking into marks. Here is the number. Gross sale process minus book value of the fixed asset. I'll get capital gain tax. Finally, I should arrive net sale process. So this is your net salvage value after adjusting capital gain tax. To this number, you please add back realization of working capital. Realization of working capital. Then I'll get terminal cash inflow. Finally, I'll get terminal cash inflow. This is my terminal cash inflow. So this is regarding step number 4. Please copy this. Yes. And also, dear students, sometimes your gross sale process should be adjusted with tax shield instead of capital gain tax. Why, sir? Because you need not always earn capital gain only. Sometimes by selling fixed assets, you may suffer capital loss also. If it is a capital loss, you can enjoy tax shield or tax saving. Such tax saving is a cash inflow. Accordingly, you should calculate it. Okay. So, or I'm writing the numbers again. Gross sale proceeds. Just for the sake of understanding, I'm taking the numbers. See, I've sold my asset for 1 lakh, whereas the book value of the same asset at the end of the project life is 1,10,000. So the asset which is having a book value of 1,10,000 was sold for 1 lakh rupees. So you're suffering a capital loss. A capital loss of 10,000. This is a loss because the book value is 1,10,000, whereas the sale value is 1 lakh. So you're suffering a loss of 10,000. So for this capital loss, generally you don't need to pay capital gain tax. Why? Because this is not a gain. Then what about this loss, sir? The loss means this capital loss results in tax shield. Why? Because this capital loss can be adjusted against the capital gain of other asset. The capital gain which arises by selling other assets, so that you can avoid tax liability on the other gain, so that you can save your tax liability. So my dear students, by adjusting this capital loss against the capital gain by selling other assets, I don't need to pay capital gain tax on the other assets, so that I can save my tax liability by selling other assets. So I don't need to pay capital gain tax to the extent of this 10,000 capital gain actually. Why? Because this loss can be adjusted against the gain of other assets, the gain from other assets, so that overall the company can save its tax liability by adjusting this loss against the gains of any other asset by selling it. Okay. So such saving arises, since such saving arises because of this capital loss only, you should recognize such tax saving here only. So how to recognize such tax saving? I'll write the tax saving like this: tax shield. Tax shield is nothing but tax saving. Tax saving is nothing but by adjusting this capital loss against the capital gain of other assets, I can reduce my tax liability by not paying tax on that particular capital gain. So I am not paying such capital gain tax on such capital gain by selling other assets, because I am adjusting this capital loss. So recognize such saving here only, just to test the viability of this particular project clearly. Okay. So tax shield. Say for example, if tax rate is 30%, I'll get tax shield of 3,000 rupees. See, tax shield is a cash inflow. Tax saving on capital loss is a cash inflow. It is not a cash outflow. So dear students, understand one thing. See, forget about the logic of why we are getting tax shield. Just follow the process. Gross sale proceeds minus book value, I'll get capital loss. In case if I'm suffering capital loss, calculate tax shield on it straight away. This is not a cash outflow. This is a cash inflow. Earlier, capital gain tax is a cash outflow, whereas this tax shield is a cash inflow. This is a cash inflow, and this is also a cash inflow. So cash inflow should be added. You should not deduct this tax shield from gross sale process. So whereas the capital gain tax is a cash outflow that was supposed to be deducted from gross sale process. Here, the tax shield is a cash inflow. It is supposed to be added to gross sale process in order to arrive net sale proceeds. So gross sale proceeds plus tax shield gives me what? Net sale proceeds. Net sale proceeds. A plus B. And that is 1,03,000. So instead of taking these numbers, you can take into marks for the sake of writing the format. Add realization of working capital. Add realization of working capital. As usual, see, either the first format or the second format should be followed based on the requirement. I've written both the formats here, okay, so that I'll get terminal cash inflow. Just look at the format again, the second format: gross sale proceeds minus book value, capital loss. Apply tax shield on capital loss. Add this tax shield to your gross sale process in order to arrive net sale proceeds. Add realization of working capital. Then ultimately I'll get terminal cash inflow. With this, successfully we understood the first area called identification of cash flows. Now I'll show you the format which is given in the study material, because everything is okay. Yes. Let me show you the format which is given in the study material, because the operating cash inflow can be calculated in different ways. It can be calculated in different ways. So I'll show you the format here. See, initial cash outflows, no need to understand it again. So already we understood how to calculate initial cash outflows. Yes. Now here it is. Operating cash inflows can be calculated in different ways. Why? Because the total cost need not always be deducted by way of variable and cash fixed cost only. Sometimes it can be deducted in different forms. Here is the format here, my dear students. Here is the format. Net sales revenue. Yeah, it is sales minus, instead of deducting variable and cash fixed cost, they have deducted like this. The cost of goods sold less cost of goods sold, general expenses other than interest. You should not deduct interest while calculating CFAD. Okay. Never ever deduct interest while calculating CFAD. That's the rule. So net sales revenue less cost of goods sold minus general expenses other than interest. And also they have deducted depreciation directly here. Then I got what? PBIT or EBIT, which means profit before interest and tax, earnings before interest and tax. I've written, they've taken EBIT here, but they don't deduct interest here. This is the rule. Remember that. Okay. So EBIT less tax. Directly, you please deduct tax. If you deduct tax, you'll get profit after tax. Then add back depreciation to it to arrive what? CFAD. Yes. Okay. See, here is your net cash inflow after tax. Net cash inflow after tax. How to arrive that? EBIT into 1 minus tax rate plus depreciation. But T is the income tax rate. If profit after tax is taken from accounting records, which is arrived after charging interest, then the calculation will be completely changed. See the first part. Just look at the first part. This is your first part. This is your second part. Nothing but first alternative and second alternative. The first alternative says if you don't deduct interest straight away, what is the format? Net cash revenue minus cost of goods sold, general expenses, depreciation. Straight away deduct these three expenses. Sometimes the expenses can be given in any other form. They've taken like this: cost of goods sold and cash fixed cost. Like that they can take. Sometimes they can take variable cost, and then after that they can take cash fixed cost, cash manufacturing cost, cash administration cost. Like that they can take. See, the deductions can be given in any form. Ultimately, those are revenue expenses. Okay, the names may be different, but ultimately you should deduct all of such revenue expenses from net sales revenue. See how you can deduct that we can understand while solving the problems, dear students. So net sales revenue minus cost of goods sold, general expenses excluding interest, and deduct depreciation. Then I will get what? EBIT, and deduct straight away tax from it, income tax from it. Then I'll get profit after tax. Add depreciation to it. Then you'll get CFAT, cash flows after tax, or net cash inflows after tax. Okay. So the rule is you should not deduct interest. In case if you are taking profit after tax from accounting records, you are taking profit after tax. So while arriving such profit after tax, if you have already deducted interest, then the calculation of CFAT will change. It will change completely. How I can calculate that? First of all, I should write profit after charging interest, PAT. Profit after charging interest, that I should write. Then I should add depreciation to it. Add depreciation. Then I should add interest net of taxes. Interest net of taxes means total interest minus tax on interest. See, like this, I minus I into T. Okay, I into T. This is a formula. Interest minus interest into tax rate. Then if you add this number, then I'll get net cash inflows after tax. I'm just repeating the format. See, in case I'll write it here. Okay, just for the sake of understanding, I'm writing it here. If I'm taking profit after tax from accounting records, if PAT is taken from accounting records, after charging interest, then the calculation will be slightly changed, because you are not supposed to deduct interest. That should be added back. Since the tax adjustment has already been taken, you should adjust such tax saving also. So how I can do that? Profit after tax. Take this profit after tax after charging interest. That means this profit after tax must be the profit PAT after deducting interest. Okay. Then to this, add back depreciation. Then you should add interest into 1 minus income tax rate. Then finally, I'll get CFAT, cash flows after tax. Cash flows after tax. Or net cash inflows after tax. See, this is generally we don't use this particular part in the while solving problems. Why? Because always the first format, you can see the first format in the problems while solving it. Okay, so take this. Yes. Now, with this we understood how to define cash flows. Now let us go for the illustration just to understand it. Yes. Here is illustration number 1. This is regarding identification of cash flows. From the following information, calculate net cash inflows after tax. Nothing but CFAT. Cash flows after tax. Net sales revenue minus cost of goods sold, operating expenses, depreciation. Then I got 8 lakh rupees. So this is your total expenditure. COGS and operating expenses. Operating expenses is nothing but admin and selling and distribution expenses. Admin and selling and distribution expenses. Okay. Depreciation 1 lakh. Total 8 lakhs deducted. They got EBIT less interest, EBT less tax of 30%, and they got PAT. From this, you have to calculate what? Net cash inflows after tax. See, there are two ways to calculate CFAT here. Let me do it. There are two ways here. One is, this is a simple problem. I'll show you the solution directly. First, straight away deduct tax from EBIT without deducting interest. Then you'll get profit after tax. See, arrive this number. 2 lakhs is your EBIT into 30%. That's your tax. Deduct it. You got 1,40,000 profit after tax. Add depreciation. That is 1 lakh. Then I'll get net cash flows after tax. This is alternative 1. Now the second alternative is, take the profit after tax directly here. Add depreciation 1 lakh. 2,05,000. Then what I should do? Interest into 1 minus tax rate. You know, the interest component is 50,000 into 1 minus tax rate. Your tax rate is 30%. Interest into 1 minus tax rate. I can do like this. I said what? Interest into 1 minus tax rate. Just like this. 50,000 into 1 minus 0.3. 50,000 into 1 minus 0.3. Interest into 1 minus tax rate. $50,000 into 1 minus 0.3. So it will be 50,000 into 0.7. I got 35,000 directly. Or else you can write like this: interest less income tax, tax on interest 30%. So 15,000, if you deduct it, you'll get 35,000. Add this number. So that I'll get 2,05,000 plus 35,000, 2,40,000 net cash inflows after tax. So this is what the second format. Just now we have written, if you remember, what was that? Profit after tax after deducting interest, less add depreciation, add interest into 1 minus tax rate. I got CF80. Okay. This is a way to calculate CF80. These are the two alternatives. Okay. Yes, dear students. One is directly from EB80. EB80 into 1 minus tax rate. I mean EB80 in EB80 less tax. I got P80, add depreciation, CF80. Or else you can take P80 directly, add depreciation, then interest into 1 minus tax rate if it is already deducted. Then I'll get net cash inflows after tax, CF80. Okay, the most important area we are entering now. What was that? The capital budgeting techniques. This is the most important area in this chapter. Capital budgeting techniques or methods. Capital budgeting techniques or methods. You know, dear students, the very basic requirement of this chapter is to apply capital budgeting techniques. Our investment decisions will be much more productive and effective if you can apply these capital budgeting techniques, because techniques will simplify your decision making process and that gives you more effective results while selecting the projects. I can select the best project among many projects by applying these capital budgeting techniques. This is the importance of these capital budgeting techniques. These capital budgeting techniques are of two types. One is non-discounting techniques. Non-discounting techniques. Second one, discounting techniques. These non-discounting techniques are also known as traditional techniques. Discounting techniques are also known as time adjusted techniques. Or modern methods or modern techniques. Non-discounting techniques are traditional techniques. Discounting techniques are time adjusted techniques or modern techniques. Yes. First one, non-discounting techniques. What are the non-discounting techniques? The first one is ARR, average rate of return. ARR. This is also known as accounting rate of return, that I'll write while explaining this particular technique. The second technique is payback period. This is your second technique. Payback period reciprocal. Payback profitability. These are the non-discounting techniques or traditional techniques. So non-discounting techniques means what? Non-discounting techniques means these techniques will never consider time value of money. I'll never apply the concept of discounting. Always I'll consider the straight numbers without using the concept of discounting. The present value, future value application is not required for while applying these capital busting techniques. So what are the capital busting techniques? Non-discounting techniques. Non-discounting techniques means these techniques will never consider time value of money. So what are the techniques? ARR, average rate of return, also known as accounting rate of return, payback period reciprocal, payback profitability. These are the techniques. Now let me write the techniques under discounting techniques. See, before writing the techniques, I'm telling one thing here. Discounting techniques means those techniques which will consider time value of money. If you consider time value of money like that means the application of present value and future value by using the formulas 1 by 1 plus r whole to the power of n, then such techniques are discounting techniques. There is a difference between the present value and future value according to these techniques. Okay. So what are those techniques? One is, the first and important technique is net present value. Net present value. NPV. Second technique, profitability index. Next one, IRR, internal rate of return. Internal rate of return, IRR. Next technique, discounted payback period. Discounted payback period. Okay. Next one, modified NPV. Modified IRR. Adjusted present value. Adjusted present value, also known as adjusted NPV or adjusted NPV. These are the discounting techniques, dear students. So please write these techniques once. Then we can start with the first technique, ARR. Yes. Okay. Let us start with the first technique, ARR, or average rate of return, or accounting rate of return, or annual rate of return. That's our first non-discounting technique. So I'm starting with the first set of techniques, non-discounting techniques, which will never consider time value of money. Okay. So non-discounting techniques. In that, I'm taking the first area called average rate of return. or accounting rate of return. Accounting rate of return. Or annual rate of return. In simple terms, ARR. This is our first technique. The question, sir, what is this technique ARR? I'm just literally writing the term again, average rate of return. My dear students, return means profit. Rate of return means the percentage of profit. So, and I should calculate such percentage of profit by taking the average of future year's profits. So, return means profit. If you convert such profit into a percentage, then that is known as rate of return. Generally, the profit is a variable number. I should take the average for the entire project life. So that is simply known as what? Average rate of return. Nothing but average percentage of profit. So how to take this average rate of return? You know, we have several methods to calculate this ARR. One is original investment method. Another one is average investment method. Just by taking original investment is nothing but your initial investment. So by taking initial investment, I can calculate ARR, or by taking average investment, I can calculate ARR. Let us take one example to understand this. Say for example, there is a project with a life of 3 years. 1, 2, 3. My investment today is 1 lakh rupees. This is my initial investment in fixed assets. That's my investment. There is no working capital investment here. This is my original investment or initial investment. By investing 1 lakh, I'm getting a profit after tax. You know, the only term which is representing profit in your income statement is PAT. I told you already. Okay. So I said what? Average rate of return. So return means profit. Profit doesn't mean CFAT, because CFAT is the combination of two components, investment plus profit. Whereas I need profit only here. So I should take PAT rather than CFAT. Don't consider CFAT for calculating ARR, because I need return only, profit only here. So I must consider PAT only. Okay. So let us say I'm earning a profit after tax of 25,000 for first year, 25,000 for second year, and again 25,000 for third year. These are your profits. Okay. Every year I am earning same profit. Now I need to take the average of all these 3 years profits, because I may not earn every year same profit. Sometimes the every year profit can be changed. So what I should do? First take the average profit here. Average profit after tax. How to get it? 25,000 plus, add all the profits, 25,000 plus, or add all the years profits, 25,000. All the 3 years profit should be divided with number of years, 3 years. So 25,000 into, 25,000 plus 25,000 plus 25,000, I'll get 75,000 divided by 3. So the average profit after tax is 25,000. Now this, by taking this average profit after tax, I can calculate ARR. Simple. For calculating rate of return, generally what we'll do? Income by investment. Say for example, if I invest 1 lakh rupees in a bank, at the end of the first year, they gave me 15,000 rupees interest. So if you ask me what is your return, simple. I'll write the income in the numerator, 15,000, and I'll write my investment in the denominator, 1 lakh. 15,000 interest income divided by 1 lakh, that gives me 15%. You can calculate that. Even you can say like that, 15% is my rate of interest or rate of return by investing my money in a bank. Now, in the similar way, you are putting your money in a project. You are investing your money in a project. So, by investing your money in the project, how much rate of return you are earning? So, simply write your investment in the denominator and write your profit in the numerator, because I am earning profits by investing money in the business. So, write the profit in the numerator and write your investment in the denominator. So, but the problem here is your profit is not a fixed number, it is a variable number. So, I should not write simple profit straight away. I should write what? Average profit after tax. Average profit I should write in the numerator, and in the denominator, either I can take original investment, total investment, or I can take average investment. It is based on the method that you are following. Okay. So, yes, we have two methods here for calculating ARR. Okay. See, if you ask me a simple way of understanding, ARR is equal to my average profit after tax is 25,000 divided by my initial investment is 1 lakh. So, my rate of return will be 25,000 divided by 1 lakh. It will be 25%. I've just calculated like this. See, 25% means 25 by 100. That means for every 100 rupees of investment in the project, I'm earning a profit of 25 rupees every year. I'm earning a profit after tax of 25 rupees every year. That is what the literal interpretation of the term ARR, average rate of return. On an average, how much return you are earning. That's what ARR. See, for calculating this ARR, we have two types of methods. First one is original investment method. I'm writing it. Original investment method. See, original investment method. Under this method, the formula for ARR is write your investment in the denominator and write your profit in the numerator. So, I have to write average profit after tax divided by average profit after tax divided by original investment, or I can write initial investment straight away into 100. This is a regular formula actually. ARR is equal to average profit after tax divided by original investment or initial investment into 100. Now, how to calculate average profit after tax? You know, average profit after tax is nothing but the entire project's life profit after tax. Nothing but total profit after tax divided by life of the project. Or number of years. Total profit after tax divided by life of the project or number of years. This will give me what? Average profit after tax. That's what we have done here. Total profit after tax. All the 3 years profit after tax is 75,000 divided by project life is 3 years. And I've taken that, I got average profit after tax of 25,000. Yes. This is regarding original investment method. We have another method called average investment method. Under this method, instead of taking original investment or initial investment, I'm going to take ARR is equal to average profit after tax divided by average investment. Instead of taking original investment, I'm taking what? Average investment into 100. You know how to calculate average profit after tax. Now the thing is how to define this average investment. We have a formula for calculating this average investment. Average investment is equal to half of initial investment minus salvage value plus salvage value plus additional working capital. Plus additional working capital. So your average investment is equal to half of initial investment minus salvage value plus additional working capital. This is what the formula for average investment method. Okay. See, don't go for logic behind this average investment. That's a simple thing. Opening investment plus closing investment divided by 2. So by solving that equation, you'll get this formula actually. Don't need it. Just follow the formula. That's it. Okay. It's a standard formula. Just literally by heart it and try to apply this formula in the examination. Okay. Average investment method. Under average investment method, instead of taking total investment in year 0, I'm going to take the opening and closing investment average. The project beginning and project ending average investment. The formula for such average investment is half of initial investment minus salvage value plus additional working capital. Generally, for calculating productive rate of return, we'll take this formula, average investment method. Okay. So just write the formulas from here. Yes. Now let us apply this particular formula in the problems. Go for problem number 5. Fifth problem, illustration number 5. I'm just reading the problem. Determine the average rate of return from the following data of two machines A and B. Machine A, look at machine A only. Cost is 56,125. Annual estimated income after depreciation and income tax. Annual estimated income means profit. Profit after depreciation and income tax means profit after deducting depreciation and after deducting income tax, so that I'll get profit after tax. After deducting depreciation and after deducting income tax, what I'll get? PAT. So straight away they've given what? PAT. So you don't need to calculate PAT here. They've given profit after tax for all the project life, for all the years project life. Year 1, 2, 3, 4, 5. We have different numbers and they have given total also 36,875. The estimated life of the project is 5 years. Estimated salvage value is 3,000. Depreciation has been charged on straight line basis. So this is regarding machine A. Okay. Now we are going to solve this problem under two methods. One is original investment method. Second one is average investment method. Let me do it. Problem number 5 or illustration number 5. Illustration number 5 from study material. Okay. Yes, calculation of ARR of both the machines. Yes. First machine A. First I'll write the formula. Yes, it depends upon the method that you're following. Okay, find first machine A. The first method is original investment method. What is the formula? ARR is equal to average profit after tax divided by initial investment into 100. This is what the formula for ARR. Average profit after tax by initial investment into 100 or original investment. You know, the total profit after tax for all the years is 36,875 and life is 5 years. 36,875. So I can calculate average PAT now. Average PAT is equal to 36,875 divided by project life 5 years. I'll get average profit of tax. It is 7,375. So that you can calculate ARR is equal to average profit after tax 7,375 divided by original investment is 56,125. The cost of the machine A is your original investment. The cost is nothing but your investment. Okay, machine cost. In year 0, you'll purchase this machine A. So that's your original investment. 56,125. So your ARR will be 7,375 divided by 56,125. I got 13.14%. This is original investment method. And I can solve this ARR computation by using average investment also. So for average investment, we need what? Salvage value. That salvage value is 3,000. Remember that. Okay. Now, average investment method. That is our next method. Under average investment method, the formula will be changed. ARR is equal to average profit after tax divided by average investment into 100. Already we have calculated average profit after tax, that comes to 7,375. You just need to calculate average investment by writing that complicated formula. Just by heart it. That's a simple one. If you can by heart it. Half of initial investment minus salvage value, close the bracket, write plus salvage value plus additional working capital that you are investing. WC means working capital. Half of initial investment is 56,125. That's my initial investment. The salvage value after 5 years is 3,000 plus salvage value 3,000, and we don't have any working capital investment here, nil. So 56,125 minus 3,000, 53,125 divided by 2, 26,562.5 or 563 plus 3,000. I got 29,563. Now successfully we got average investment here. Now you can calculate ARR. ARR is equal to average profit after taxes 7,375. 7,375 divided by your average investment is 29,563 into 100. 7,375 divided by 29,563. I got 24.95% approximately. Okay, let me see. Hope we got the number. Yeah, 24.9% they have taken. For both the machines, they got the same number. Why? Because the total is same. See, you can do this computation for machine B also. Since your investment is same, even though the profits for all the 5 years are same, but the total remains same. Or even though the profit of tax are different for machine A and machine B, but the aggregate number is same, so that you'll get the same average profit of tax, same salvage value, same project life, same ARR you'll get. Okay. See, this computation is applicable for both the machines. Why? Because the profit after tax for different years are different, but still the total profit after tax for both the machines are same. So the average profit after tax for both the machines are same. Since your investment is same for both the machines, salvage value is same for both the machines, the term is same for both the machines. If you calculate ARR, you'll get the same numbers. Okay. So please copy this. Just copy the solution. Yes. The same computation is applicable even for machine B also. Okay. Right. In the next session, we'll handle the other areas. Bye.